Retirees alert. If you rely on Canada Pension Plan income, or if you plan to retire in the next few years, you need to pay very close attention to this video. Because in 2026, changes to the Canada Pension Plan could directly impact how much money lands in your bank account every single month. And here's the part most people don't realize yet. These changes are not just small technical updates. For some retirees, they could mean higher payments. For others, they could affect eligibility timing, contribution history, or even future increases. Yet many seniors are still unaware of what's coming. Welcome back to CPP News and Finance Updates, the channel where we break down Canada Pension Plan news in simple, clear language so you can protect your retirement income and avoid surprises. Today's video is especially important because what you do now and what you understand now could make a real difference to your financial security in 2026 and beyond. Let's start with the big question. Why is CPP changing in 2026 at all? The answer goes back several years. Canada has been gradually strengthening the Canada Pension Plan to help future retirees keep up with rising living costs. Inflation, housing, groceries, utilities, and healthcare have all become more expensive, and policymakers recognize that the old CPP structure alone was not enough to replace a meaningful portion of retirement income. So the government introduced what's known as the enhanced CPP, and that enhancement continues to roll out in stages. By 2026, another key phase of this enhancement becomes fully active, and that's where the impact on your monthly income comes in. Now, it's important to understand something very clearly. CPP changes do not happen overnight like flipping a switch. They build slowly, year by year, based on contributions, earnings, and timing. That's why many retirees miss what's happening until they see a change in their payment or receive a notice they don't fully understand. Our goal today is to make sure that doesn't happen to you. Let's talk about what actually changes in 2026 and how it may affect retirees and near retirees. First, one of the biggest factors is the full implementation of enhanced CPP benefits tied to higher contribution ceilings. Over the past several years, workers have been contributing slightly more to CPP, and employers have been matching those contributions. In 2026, the system fully reflects those higher contribution levels for eligible earnings. What does this mean in plain language? It means that people who contributed at higher earnings levels over time may begin to see stronger CPP payouts compared to the old CPP formula. However, and this is very important, not everyone benefits equally. If you retired many years ago, your CPP is mostly based on past contributions under the older system. If you are retiring closer to 2026, or if you continue working while receiving CPP, the enhanced portion can play a bigger role in your monthly payment. This brings us to a crucial point many retirees misunderstand. CPP is not a flat benefit. Two retirees can live on the same street, retire in the same year, and receive very different CPP payments. Why? Because CPP is based on how much you earned, how long you contributed, and when you started taking your pension. The 2026 changes interact with all three of these factors. Now let's talk about monthly income, because that's what matters most when you're paying bills. For some retirees, the changes in 2026 could mean gradual increases in monthly CPP payments over time, especially when combined with annual cost of living adjustments. CPP is indexed to inflation, which means payments are reviewed and adjusted each year to reflect changes in the cost of living. If inflation remains a concern, CPP adjustments in and after 2026 could become more noticeable. That said, higher inflation does not always mean higher purchasing power because prices may still rise faster than benefits. This is why understanding CPP is not just about the headline numbers. It's about real-life impact. Groceries, rent, utilities, insurance, and medical costs don't care about government announcements. They care about what's actually in your bank account. Another change retirees should be aware of involves post-retirement benefits. If you are between the ages of 60 and 70 and continue working while receiving CPP, you may still be contributing to CPP unless you opt out after a certain age. These additional contributions can slightly increase your CPP through what's known as post-retirement benefits. In 2026, these enhancements continue to factor into total CPP income, meaning working retirees could see small but meaningful increases over time. But here's where many people get caught off guard. Not all increases are automatic, and not all retirees qualify for the same enhancements. Your contribution record matters more than ever. If there are gaps in your CPP contributions, or if you had years of lower earnings, those gaps still affect your benefit calculation. This is why checking your CPP statement of contributions is absolutely critical. Yet many retirees have never looked at it. It shows your contribution history year by year and provides an estimate of your CPP at different starting ages. With changes unfolding in 2026, reviewing this statement can help you understand whether you're likely to benefit more, less, or about the same. Now let's address a very common question we receive here at CPP News and Finance Updates. Should you delay taking CPP because of the 2026 changes? The answer depends on your personal situation. Delaying CPP past age 65 increases your monthly payment, while taking it early reduces it. The enhanced CPP does not change this fundamental rule. However, higher future benefits under the enhanced system may make delaying more attractive for some people, especially if they have other income sources or good health. On the other hand, if you need the money now to cover essential expenses, delaying CPP just to chase higher future payments may not make sense. CPP is designed to be flexible, but it is not one size fits all. The 2026 changes don't eliminate that reality. They simply add another layer to the decision. Let's also talk about expectations because misinformation spreads fast online. You may see headlines claiming massive CPP increases in 2026 or suggesting that everyone's payments will jump dramatically. That's not accurate. While enhancements strengthen the system over time, they do not suddenly double or triple benefits for current retirees. Any increases tend to be gradual and based on contribution history. Understanding this helps avoid disappointment and poor financial planning decisions. Another key issue in 2026 is sustainability. The Canada Pension Plan is jointly managed by federal and provincial governments with a focus on long-term stability. Changes are designed to ensure CPP remains financially sound for decades to come. That's good news for retirees who depend on it because it reduces the risk of sudden cuts. However, stability also means changes are measured, not dramatic. Let's shift focus for a moment to future retirees watching this video. If you're still working and plan to retire around 2026 or later, these changes are especially relevant. Higher contribution limits and enhanced benefits could improve your CPP compared to previous generations. But this only happens if you contribute consistently and understand how CPP fits into your overall retirement plan. CPP was never meant to replace 100% of your working income. It is one pillar of retirement income, along with old age security, personal savings, employer pensions, and investments. The 2026 changes strengthen that pillar, but they don't remove the need for personal planning. For current retirees, the key takeaway is awareness. Monitor your payments, watch for official notices, review your contribution record, and stay informed through reliable sources, not rumors. We've seen too many seniors panic because they hear about CPP changes without context. Some worry their benefits will be cut. Others assume they'll receive large increases that never materialize. Both misunderstandings can lead to stress and poor financial decisions. At CPP News and Finance Updates, our mission is to cut through that confusion. We focus on what's confirmed, what's realistic, and what actually affects your monthly income. Now, before we wrap up, let's summarize the most important points you should remember. CPP changes in 2026 are part of a long-term enhancement plan, not a sudden overhaul. The impact on your monthly income depends on your contribution history, earnings, and when you started or plan to start CPP. Some retirees may see gradual increases, especially when combined with inflation adjustments, while others may notice little change. Working retirees may benefit from post-retirement contributions, and future retirees may see stronger benefits if they contribute consistently under the enhanced system. Most importantly, staying informed gives you control. CPP should never be a mystery. It's your money based on your work, and you deserve to understand how it works. If this video helped you, or if you learned something new today, make sure to like the video so more Canadians can see it. And don't forget to subscribe to CPP News and Finance Updates, because we bring you clear, honest updates on CPP, OAS, and Canada's retirement system without the noise or confusion. Turn on notifications so you never miss an update, especially as we get closer to 2026 and more details become available. And if you have questions or want us to cover a specific CPP topic, leave a comment below. We read them, and many of our future videos are based on your questions. Your retirement income matters. Your peace of mind matters. And staying informed today can protect you tomorrow. Thanks for watching, and we'll see you in the next update right here on CPP News and Finance Updates.